Good afternoon. I'm Robert Mays of BlueCreek Investment Partners. Well, the market rallied again last week as the S&P 500 closed at a level that we haven't seen in the last 17 months. As a matter of fact, the S&P 500 rose over 72% from the March 9th lows a year earlier. Much of this, in our opinion, is because companies have consistently throughout all of last year have been able to beat the street estimates when it came time for their earnings releases. When we go back to the first through the third quarters, we saw that the vast majority of companies, anywhere from 68 to 78% of the time, companies outperformed the street estimate. And then even in the fourth quarter of last year, close to 75% of companies beat the analyst expectations. Because of that, we have to go back and think, well, how is that number actually aggregating for the total of all S&P 500 companies? And it's interesting because as we go back to see where analysts what number they were expecting the S&P 500 to earn in mid-part of last year versus where they are today. For example, in 2009, the average analyst thought that earnings were going to be somewhere between the $50 and $51 range, and this is actually an increase from what had previously been marked at a $40 range. Well, in fact, earnings came in at over $62 for 2009. As we look at 2010, most analysts were expecting earnings to be somewhere in the mid-60s, and now we're looking for roughly a $78 per share earnings estimate. That's a significant increase. As a matter of fact, going out to 2011, we're looking at around $93 per share. With each of these, what you can see is that yes, the market has increased, but earnings have more than kept up with that. If we look at the PE ratio based on 2010 earnings, the market is currently trading at roughly 15 times, maybe a little bit underneath that, and trading a little around 12 times, 12 and a half times earnings for 2011. So in our view, when you look at the average PE over the history of the index trading at 15.7, we believe that the market is still undervalued at this time. And certainly the current recovery that we've experienced has a lot to do with macroeconomics, but has been justified by corporate fundamentals all along this way. It'll be interesting to see how we finish the year. In our view, there's a pretty good probability that we're going to see further revisions on the upside, and maybe $78 a share this year will end up being too low of an estimate. Only time will tell, but certainly at this point the trend's been looking good. That's it for this week, and I look forward to talking to you again next Monday. Bye.